Another midstream player is Cheniere Energy, and they move predominantly natural gas. This is a $51 billion market cap company with a PE of 13.5 for the current year, and next year will be at 17.6. Pays a small dividend. The stock has really worked for the last year, and the 5 year looks excellent. And look at the trajectory of this chart. It's just gone up over the last 5 years. So this has been a superstar stock if you consider the appreciation and the rewards to investors that this stock has delivered. When you look at the financials, the revenue did contract for a couple of years. It looks like it's growing again. It had some boom periods when oil prices and natural gas prices were really high in 2022. The company has, let's take a look at free cash flow. Free cash flow has been going down. It's interesting that the stock has really held up. On the gross margin level, gross margins were as high as 83 in 1 year, but they've stabilized down to about 47, and margins have been all over the place. It's interesting to see that. And profits are pretty decent at 21%, and free cash flow yield is about 13%. Let's take a look at the forecast of what analysts have to say about this stock. Analysts, some of them believe that the stock could go up higher, much higher, and others think that the stock's just slightly discounted. On average, they think it's discounted by about 13%. They think the business is going to continue to grow and profits are going to expand a little bit. So this stock has what they think is a pretty decent future. Let's take a look at the balance sheet and see what kind of debt level we're dealing with. These guys carry $26.37 billion of debt. They have about $1.7 billion of cash. So they have a net debt balance of $24.6 billion. Debt to EBITDA is right at 3, right at the limit. So let's take a look at the valuation now for Cheniere Energy. I completed my research and my valuation for Cheniere Energy, and I come up with a 32% premium that is being priced into the stock. In other words, I think each share is worth $158, but they're selling for $232. That's a 32% premium. It's mainly on the cash flow side, just not enough cash involved that's coming into the business. And you have this debt level that a decrement from the overall value. So this is not a stock that I would be investing in. Even earnings per share doesn't get to the stock price. The stock has flourished for 5 years. It's done great, but I'm not here to buy stocks that are maybe popular or maybe have had a very good 5 year run. I'm trying to buy stocks that are unappreciated, discounted, and are going to have a very good 5 years going forward.